What if I told you that making money has less to do with intelligence and more to do with psychology? Most people think money is about math, numbers, spreadsheets, stock charts, business strategies. But in reality, money is mostly about behavior, and behavior is driven by psychology. You don't build wealth simply because you're smart. You build wealth because you think differently, react differently, and make decisions differently under pressure. Everything starts with your beliefs about money. If you believe that money is hard to make, your brain will constantly look for evidence to support that belief. If you think rich people are greedy or dishonest, you may subconsciously avoid becoming wealthy yourself. Many of our money beliefs were formed in childhood. Maybe you heard phrases like money doesn't grow on trees, or we can't afford that, or people like us don't get rich. These statements may sound normal, but over time they create a financial identity, and identity is powerful. If you see yourself as someone who always struggles financially, you'll make decisions that reinforce that story. But if you start seeing yourself as someone who learns, adapts, and finds opportunities, your behavior begins to change. The first step in making money is upgrading your identity. Another powerful psychological factor is delayed gratification. In today's American culture, convenience is everywhere. One-click purchases, same-day delivery, credit cards, buy now, pay later. Everything is designed to give you instant pleasure. But wealth is built by people who can delay gratification. The ability to say no today in order to have more tomorrow is a major advantage. Spending $500 on something impulsively feels exciting in the moment. Investing that $500 and letting it grow over years feels boring today, but powerful later. Short-term discipline creates long-term freedom. People who consistently choose future rewards over present comfort tend to win financially. Emotional control is another critical piece. You can read books about investing and follow financial advice online, but if you panic when the market drops, you'll make emotional decisions that cost you money. Look at major downturns in U.S. history. During the 2008 financial crisis and the 2020 pandemic crash, many people sold investments out of fear. Others stayed calm or even invested more while prices were low. The difference wasn't intelligence, it was emotional control. Fear and greed drive most financial decisions. When markets rise, people get greedy and overconfident. When markets fall, they get scared and sell at the worst time. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." That's psychology in action. The ability to stay rational while others are emotional is a financial superpower. Another mindset shift involves focusing on increasing income rather than obsessing only over cutting expenses. Many people are taught to save every dollar, skip small pleasures, and reduce spending at all costs. While saving is important, there is a limit to how much you can cut. There is no limit to how much you can earn. Wealthy individuals often focus more on expanding income through skills, investments, businesses, and career growth. Instead of constantly asking, "How can I save $100?" they ask, "How can I earn an extra $1,000?" That small shift changes how you approach opportunities. It moves you from scarcity thinking to growth thinking. Your environment also plays a major psychological role. Humans naturally adapt to what they see around them. If your friends constantly spend money on status items and live paycheck to paycheck, it becomes normal. If your social media feed is filled with luxury lifestyles and instant success stories, you may feel pressure to keep up. On the other hand, if you surround yourself, physically or digitally, with people who talk about investing, entrepreneurship, and long-term growth, your standards shift. Even reading books or listening to interviews from financially successful individuals can normalize wealth-building behaviors. The more you expose yourself to growth-oriented conversations, the more natural those habits become. Risk tolerance is another defining factor. Most people want financial success, but they fear financial risk. Humans are wired to avoid loss more strongly than they desire gain. Losing $100 feels more painful than gaining $100 feels rewarding. This psychological bias often keeps people stuck. However, there is a difference between reckless risk and calculated risk.
Starting a business, investing in education, changing careers, or moving to a better opportunity all involve uncertainty. Wealthy individuals are not fearless. They simply learn to evaluate risks logically instead of emotionally. They ask what the potential upside is, what the downside is, and what they can learn either way. Then they act strategically.
Long-term thinking might be the most underrated financial skill. In a world that celebrates quick money and viral success, patience feels outdated. Many people chase trends, day trade without strategy, or jump from one side hustle to another hoping for overnight wealth. But real financial growth is often boring. It's consistent investing. It's steady skill development. It's building something slowly over years. The U.S. stock market, despite short-term volatility, has historically grown over long periods. The key is time. If you can think in decades instead of days, you gain an advantage over most people who focus only on immediate results. Finally, confidence compounds just like money. The first time you negotiate your salary, you may feel uncomfortable. The first time you invest, you may feel uncertain. The first time you start a side business, you may doubt yourself. But each action builds evidence. Evidence builds confidence. Confidence encourages bigger action. Bigger action often leads to greater income. It becomes a cycle. Over time, your self-belief strengthens, and your financial decisions become more decisive and strategic. The psychology of making money isn't about secret tricks or shortcuts. It's about managing your beliefs, controlling your emotions, delaying gratification, thinking long-term, and being willing to take calculated risks. Money is simply a tool. Your mind is the real engine. When you master your psychology, financial growth becomes a natural outcome of your habits and decisions. In the end, making money isn't just about numbers in a bank account. It's about who you become in the process and whether your mindset is aligned with the future you want to create.